Good evening, everyone. Let me get set up here. I'm going to load some content, and we'll get started. Give me just a second. Yeah, you might close that door for me. Good evening, everyone. Would somebody please type in and let me know that you can hear my audio? I would greatly appreciate it. Thanks, Josh. I appreciate it. I want to tell everybody that the Shark Tank homework has been graded, and the grade should be up. If you have any questions, let me know. Send me an email. We'll get right to it. Things are going really well. Tomorrow you will have a quiz available for the bond content and the content that we had from last week that will be open for a week and due next Tuesday at 6:30. Another simple quiz for you just to keep everything rolling along. In general, everybody's doing terrific, and really happy with the progress of the class. Tonight we have a special treat in that you don't have to listen to me talk for the entire time. In fact, you're not going to get to listen to me talk hardly at all. I have a good friend of mine, Roy Kim, is with us this evening. He's going to talk to us about bonds. He's got a lot more hands-on experience with bonds than I do, and I think he can give you a lot of real-world stories or viewpoints about bonds. One thing that this is going to require, however, is that I really need you folks to, as much as possible, ask him questions, stop, send him a chat, raise your hand, whatever it is, so that we can get a good interactive session going on, because I think this could be really valuable. I will tell you that I will probably only have time to work in, a little bit of Roy's talk into the quiz, but there will clearly be questions from Roy's talk on the final, so be sure and absorb this information. He's been through the chapter. Of course, I've been through the chapter. I believe you can read. I think you can take a test based upon reading the material, but we want you to know more than just the academic angle of the book. So I'm going to turn it over to Roy. He's going to tell you a little about his career background, and then he'll go through his presentation on bonds. I will tell you, Roy grew up in Dallas and is a graduate of Green Hill School and the University of Texas, and he's going to tell us about bonds and a career in finance.
Good afternoon, everyone. Thanks for having me today. Professor Wheeler asked me to give a talk about bonds, which can be a particularly dry subject, to be honest with you, but hopefully some of my experience trading them you might find of more interest and give you a little bit of insight as to what the bond market was all about. Again, my name is Roy Kim. I studied finance and marketing with a minor in economics in college, and my first job out of college was to go work for Bank of America in Charlotte, North Carolina, where I basically hedged interest rate risk for the mortgage company. So lots of financial exposure, as you probably have read about or heard about in the media regarding mortgages. Spent about 10 years in Charlotte, kind of helping the bank manage that risk. And then in 2004, moved to New York to go work for JP Morgan, where I was a sell-side trader for the investment bank, trading specifically mortgage-backed securities. and did that for about 8 or 9 years, and very recently left there and came back to Dallas, where I'm from. So, you know, again, the subject matter of bonds can be rather dry. I've looked over your source materials. Everything you probably would need to know about bonds is in there. I thought I'd spend a little bit of time just going over some very basic mechanics with you. But we'd like to spend most of the time really discussing some real-world applications and talking a little bit about what I did for JP Morgan. It's been a very interesting 8 or 9 years, as I'm sure you're all aware. But we'll talk about bonds, bond trading, a little bit about Wall Street, and probably conclude with the discussion about what happened in 2008, which frankly was probably the most interesting part of my career. Saw some things that I'd never thought I'd see, and experienced a lot of things that were always discussed on a theoretical basis, but never really would be envisioned to actually happen, but did happen. And I hope that throughout the discussion, you guys can ask me questions. My wife would disagree with me probably, but I'm not really good at lecturing or talking to myself for very much time. So please feel free to interrupt with questions. I think it'll make the discussion more fruitful, and it'll certainly be easier on me. So I appreciate that if you would do that. Thanks. Okay, so the first slide is, what is a bond? To oversimplify a bit, it's basically a loan. I'm sure you've studied equities and other forms of capital flows in your coursework, but a bond in its simplest form is simply a loan. It's a face amount, rate of interest, and a maturity. Maturities can be 1 day, maturities can be 100 years, depending on the market and the sector you're talking about. More precisely, is that second bullet point, it's a debt instrument in which an issuer, which would be the party selling the bond, is effectively a borrower because they're selling that piece of paper in exchange for a lump sum of money, and that piece of paper represents a promise to repay. That in turn means that the buyer of the bond, or the investor, is effectively a lender to that borrower. And really the fundamental difference between a bond and a loan is that bonds have been securitized. And what does it mean to have been securitized? It simply means that bonds, the loans have been packaged and formed in a way that provides some level of standardization and in some cases some level of credit enhancement. As you know, loans can be for any term, for any amount. You can write you can agree verbally. You can write on a paper napkin. There's really no set format for a loan, but a bond requires some level of standardization so that participants in the market can trade them, buy them, sell them, and have some good feel for at least what they're getting. And the last point is that bonds are traded much like stocks. They have a ticker, just like stocks do. And they're traded, meaning they're bought and sold at varying prices for various reasons in a market. As you've witnessed in the equities markets, I'm sure the bond market is changing. It's gone from literally being a big pit with a lot of guys sitting, men and women sitting in large rooms yelling and screaming at each other, to transitioning to a more electronic format. But that said, there's still quite a bit of voice trading, and that's kind of what I did most days. So markets, as I just said, bond markets are traded in an over-the-counter market, which simply means there is no set exchange. There is no New York Stock Exchange kind of analogy to the bond market. Markets have hours. Some have screen prices, meaning that they're electronically formatted. Participants can look on a computer screen and see where things are being bought and sold, and in some cases they're not. And in fact, I would say the majority of the markets are not screen traded. And that's simply because the amount of volume or the nature of the bond kind of prevents it from becoming screen traded, simply because there's nuances to what you're buying and selling. A bond market simply a room full of traders with lots of phone lines and lots of computer screens. Buyers or sellers will call in via phone or messaging systems to ask for offers or bids on bonds, and those things are executed. Those transactions are executed by voice, or in some cases electronically over chat or instant messaging. Most bonds, you probably don't hear about the bond markets quite as much as you might hear about the equity markets, and that's primarily because bonds are typically traded by institutional clients. but not all. There are retail or individual buyers of bonds. Many of you may have investment funds that you're investing in that have a bond component to them. So bonds can be bought and sold by individuals, but the bulk of the trading is done by large financial institutions globally. Just to give you a feel for how big that market is, these numbers are as of 2010. The bond market is approximately $85 trillion in outstanding notional supply. That doesn't include derivatives or structured products. It's simply the outstanding float of bonds that are in the market globally. By comparison, equities for the same time period are almost half of that, or 45 trillion. So just to give you some scale, the bond market is an enormous market. It's global. It encompasses various sectors and encompasses buyers and sellers from all different sectors. Participants. So sellers of bonds typically are corporations, sovereigns, meaning foreign countries, mortgage lenders, and municipalities. All these entities sell or issue bonds for various reasons. At the end of the day, they're trying to borrow money. If you are a corporation, you can raise capital in a number of ways, but the primary ways of generating capital are to sell equity or sell a stake in your corporation, or borrow it. And for the other entities that you see listed there, sovereigns obviously can't issue equity. Yes. Explain a sovereign. So I'm getting a question from Professor Wheeler to explain a little bit in more detail what a sovereign is. A sovereign is simply a foreign country, or any country for that matter. And countries, like any other entity, have capital needs. Unfortunately, as we experience here in the U.S., we often spend more than we take in. And so that deficit has to be filled in some way. And given that countries can't sell equity in their country, so to speak, they borrow it. You've heard of the U.S. Treasury market, and the Treasury market is simply the way for the U.S. government to borrow money to satisfy the expenditures which exceed what they take in income or taxes. Various sovereigns have various credit ratings and have various levels of debt and various levels of risk tolerance. But they're like any other borrower. They need money. And they have a higher level of expenditure than they have in income, and so the way they fill that gap is to borrow it. I'm getting a question from Josh. In the global market, how does U.S. measure up to other countries in the bond market? Can the other students see, Scott, can the other students see the questions? Okay, so I don't have to repeat them. The U.S. is obviously one of the largest players out there. It's generally going to be a function of GDP and deficit, and we are the largest economy in the world, and therefore we tend to have the highest capital needs. If you want to use probably a country like Japan or the UK as an example, our bond markets are several multiples of those sizes. And again, it's a function of our GDP. And unfortunately, it's also a function of our economic state. To the extent that we have higher expenditures than we take in income or taxes, it increases our borrowing needs. Further, there's great demand for U.S. bonds. So there's when you think about the flow of capital, to the extent that as American consumers we buy things from other countries, we generally transact those things in U.S. dollars. So those dollars flow overseas, China, let's say, and when that occurs, the Chinese government then, or the Chinese China in aggregate then has U.S. dollars to invest, and typically those funds are invested back into U.S. Treasury bonds. Buyers of bonds. Buyers of bonds include various entities for various reasons. Insurance companies. And insurance companies have liabilities. Life insurance companies have to pay out settlements. They have to pay out benefits when clients pass away. It's simply that their business is to match their asset base with their liability base. So for an insurance company, the liability base are policies and policy obligations, and to match those policies, they have to then invest in assets that kind of match that. So insurance companies will buy bonds to provide kind of a predictable flow of income to match what their liabilities are at some point in the future. investment funds. The hedge funds, the Fidelities or the Schwabs of the world buy bonds as part of a kind of a multi-pronged investment strategy to invest their clients' monies in. Individuals buy bonds, and foreign central banks buy bonds, just as we discussed earlier. An interesting note is, at one point, I think this number is several years old, but there was something like $300 million an hour flowing into China, meaning that $300 million of goods were being purchased by Americans on an hourly basis. Those dollars flow into China's coffers. They then need to do something with that money, and so typically foreign central banks will take excess reserves or excess funds and invest them into the U.S. bond market. Why the U.S. bond market? Because it is deemed to be the safest bond market or the safest bond instrument in the world. Things have gotten dicey here in the last few years at times, but at the end of the day, I think it's clear that the U.S. economy and the U.S. government is still probably the closest thing to a risk-free investment that you'll be able to find. You've probably studied the risk-free rate in various things in your classes, and generally that refers to the interest rate at which the U.S. government can borrow. Why is it considered risk-free? I think we've all learned that there's really no such thing as risk-free, but it's probably the closest thing. The U.S. government, based on the size of the U.S. economy, always has taxing authority. So to the extent that it can't meet its obligations, it always has the power to kind of raise taxes and raise money. And it would be raising that money from a base of market participants that is the largest and the strongest in the world. So some key features of the bond, much like a loan, there is a par value or a face amount of the bond. There is a coupon rate, which is a stated interest rate. It's called a coupon rate, by the way, because in the old days there used to be coupons attached to a little payment book, and when the when the bond investor wanted his money, he would rip the coupon off the book and mail it into the issuer, and the issuer would mail him back a check. But at the end of the day, that's simply the rate of interest that's being paid on the face amount. Maturity is simply the day that the loan ends or the bond terminates. Again, that can be one day, it can be 10 years, it can be 100 years. It's just whatever the issuer would like to do and what the market will tolerate. The issue date is the starting date, and the yield to maturity is quite simply what you will earn on that investment, assuming that you buy the bond at par or 100% of the face value and hold it until it matures. Bonds are structured in various ways, principal and interest are returned in various ways, but for purposes of the discussion today, we'll just assume that on day one when you buy the bond, you pay the face value for it, and on the maturity date you will get that principal back, and in the intervening time you'll get coupon payments, let's just say annually, that represent the coupon rate times the face amount. Bond yields. Again, we just discussed yield to maturity. Something that's kind of important to understand about bonds is that they go up and down in price. So, for example, if you have a bond that is yielding 10%, but something strange happens in the market and suddenly market rates are 20%, suddenly that bond's not worth as much. I can offer you a piece of paper that says I'll pay you 10% a year, but why would you take that when you can go get a different piece of paper at current market rates of 20? And the way I would entice you to do that would be to offer my bond to you at something lower than the face value. So if it was $1 million bond, maybe I would sell it to you for $980,000, something less than that, which would then bring your yield up to market levels. And the exact inverse is true. If you're holding a bond that's earning 10% and market rates decline suddenly, suddenly that cash flow is worth a lot more. And so investors would be willing to pay higher than the face amount to get that bond. And in theory, things should, the market prices of bonds should move and settle on a level that is representative of where the current market rates are. And in that way, the bond markets move with interest rates. Sometimes they drive interest rates. Sometimes interest rates drive bond prices. But at the end of the day, you can think of bonds as simply a way of trading interest rates. And as interest rates go up and down, bonds go up and down in value as well. Down, right. So Professor Wheeler is asking about the relationship between interest rates and prices. I actually think I have a slide on that in a little bit, but it's an inverse relationship. So as market rates go up, again, because a bond's coupon is fixed, that value should go down, and the inverse should be true. And this all stems from the fact that, one, there's a market level of rates that fluctuates, and investors theoretically have an opportunity to buy your bond or go out into the marketplace and buy other bonds. And secondly, it hinges on the fact that the coupon rate on the bond is fixed. It's actually written onto the piece of paper. It does not change. There are bonds that have variable rates of interest. For the most part, though, they're a fixed coupon. And since that coupon doesn't change, that piece of paper will go up and down in value depending on what the next best opportunity cost is for that investor. Here's a very simple yield example. Again, I don't want to bore you with this. There's plenty of reference material for you to kind of go over this in detail, but just for purposes of this discussion, let's take the example of a $1 million face bond with a 10-year maturity with a 10% coupon. So again, it's a piece of paper that says, I owe you $1 million for 10 years. I'll pay it back in 10 years, and in the meantime, I'll pay you 10% of that $1 million every year. So that coupon payment would be 10% of $1 million or $100,000. That doesn't change. That's constant. It stays the same for the life of the bond. And so if I were to buy that bond at par or a dollar price of 100, the bond would be a 10% yield. Pretty straightforward. If I were to pay more than 100% of the face value of the bond, so on a $1 million bond, if I were to pay you $1,020,000 for that bond, I'm still only getting $100,000 a year. And so now my return is lower because I'm only getting $100,000 not on $1 million invested, but on $1,020,000 invested. And so you can see there that as the price goes up, the yield on the bond goes down because I'm paying more for a coupon payment that's fixed, in this case $100,000 a year. The exact opposite is true for discount. When rates go up, to entice that investor to buy my $1 million bond, I might have to sell it to him for less than $1 million. So if you, as an investor, were to pay $980,000 for that bond, again, you'd continue to receive $100,000 a year, and that would then give you a yield something above 10%. So this is kind of critical to understand because there was a time when bonds weren't traded. They were issued and sold to investors that would then hold them forever. And their yield was the coupon, and the coupon was the yield, and nothing changed. Sometime in the late 70s, early 80s, someone smarter than me figured out that, you know what, we can buy and sell these things at different prices and just kind of make the investor whole. And that created what eventually became the current bond market. And so now prices now can reflect changes in interest rates, and as we'll learn later, they can also reflect different levels of risk, perceived risk, real risk, credit risk that's embedded in the bond. And again, this is very relevant for what we're going to talk about at the end of the discussion as to what happened in 2008. And there at the bottom, clearly prices and yields are inversely related. So as yields go up, as prices go up, yields will go down. As prices go down, yields will go up. The example is right above it. I think it's pretty straightforward. If anyone's not clear on that, I'd be glad to go over it again. Here's some of the dry math that I was referring to. It's really all I wanted. Can they see my pointer, Scott? Okay, so really all this means is that these hash marks basically are years. And in my example, you know, you would get a coupon payment every year of $100,000. So at the beginning of time, when you pay a little bit more for this bond because it has a higher coupon than 10, over time as you get towards maturity, it's going to come back towards par. And that's because you're getting fewer payments. If you buy the bond here, you're going to have 10 payments that are above market rates. But if you buy the bond here, you only get 1. And therefore, there's this notion of what's called pull to par, which is that any bond, whether it's a premium in this case or a discount in this case, as time goes forward and the number of coupons you're getting that are either above market or below market decreases, that bond will again approach the face value of the bond because in fact that's the principal that you'll get back at maturity. That's also pretty interesting, pretty important concept to understand, the pull to par. Again, your reference materials covers this in a bunch of detail. So risks. Quite simply, there's 3 basic risks to bonds. One is price risk, which we just spent a lot of time talking about, which is that as market rates change and opportunities for investors to get or invest in current rates change, the price of the bond will move up or down, as we just discussed. This price sensitivity or this price risk is known as duration. Duration is simply a bond's price sensitivity to a change in rate. So if rates go up X, how much will the price of the bond go down, and vice versa. It's an important concept. It's relatively simple. For those that are a little bit more mathematically inclined, you can think of it as a slope, or a change in X over a change in Y. So if rates move X, then price of Y moves Y. And that relationship, as we'll go over in a little bit, is a function of how long or how much duration is on the bond, or how long before the bond matures. Default risk, quite frankly, anytime you loan someone money, they may not pay you back. Or they may pay some of it back, or they may not pay it back as they promise to pay it back. And this occurs. This occurs in the marketplace. We learned this in 2008. It happens all the time. Corporations are late in making payments sometimes. Sometimes they go bankrupt. There's various reasons for default, and we'll go over some of that in a little bit, but that's the second major risk in bonds. And the final risk is call risk. And call risk is basically, another way of explaining call risk is that sometimes the bond that you think you bought isn't as long or short as you thought. So if you thought you bought a 10-year bond, sometimes that bond might go away in 8 years. And if that happens, then suddenly you're not getting the yield or the return that you thought you did. The opposite can happen as well. The bond can end up being longer than you thought. And we'll go over that in a little bit too. But basically that call risk basically describes the uncertainty that might occur in some cases where a bond ends up being longer or shorter than what you anticipated. So we'll go through these risks one at a time real quickly. Price risk, we just spent a lot of time about that. There's your slide that talks about the inverse relationship between prices and rates. That notion, or that concept, is known as duration. Again, an important concept I'd probably review if you had some time later. And here's just an example. You might be able to figure this out. It's pretty straightforward, but if a bond's a 1-year long bond versus a 10-year long bond, which ones have more price risk? The answer is the 10-year. Why? Because you've got coupon payments that last 10 years. You're locked in, so to speak. So if rates were to go lower than what you have in your bond portfolio, that's a good thing. You're going to earn 10% when everyone else, the best they can get is 5%, and you're going to get to do that for 10 years. And therefore, the price sensitivity of that bond is much greater, as you can see by these percentages. And conversely, if you own a 10% bond that's a 10-year long bond, but interest rates go up to 15%, suddenly you're sitting on something that's underwater or not earning what others could earn in the market, and so that price goes down, and you're locked into it for 10 years. And therefore, your present values suffer even greater. And so what you're seeing, these differences in change percentages are basically duration. And what this means to say is that bonds that are longer in maturity have more duration. Default risk. This is pretty common sense, but there's various reasons why an issuer may default. A default doesn't necessarily mean they don't pay you at all. They might be able to pay you some, but not all. They may be able to pay you all, but later than expected. They may not be, or they may pay you in different increments. Anything that varies from the original terms of the contract is considered a default. In the corporate world, where corporate investors are issuing bonds, the default typically means the company's either gone out of business or has a cash shortfall and just can't make their payment. In the case of a sovereign, it's a little bit more of a severe situation. Hopefully this never happens. I'm sure you've seen some stories in the media about some of the wrangling that's going on in Congress and some of the risks that we're incurring in the marketplace as an issuer. And it's a big deal because there are global investors that buy U.S. Treasury bonds on the expectation that the U.S. Treasury is not going to default. But recently, and I think you may have read about, some of you may have read about this in the media, but a couple of the rating agencies actually kind of put the U.S. government on warning, meaning that they were threatening to lower our credit ratings. Not because we don't have enough money, because we could always raise taxes, or we could always raise monies in various ways, but because of the, I'm trying to find the right word for it, but some of the shenanigans that go on in Congress that kind of some of the politicking that sometimes gets in the way of us kind of functioning the way we should on a financial basis as we should, given that we're a very large borrower in the marketplace. And so in the case of a corporate entity, obviously financial strength and risk related to financial strength are what are drivers of default. But in other cases, in the case of sovereigns, sometimes it can be politically motivated. It can be stability motivated. If you were to buy the bonds that were issued by, let's say, Libya, maybe plenty of money there, but if there is a coup or a destabilization of the government, that could also affect the government's willing to repay its bonds. So there are various drivers of default risk. It's not always financial losses or financial risk, but again, it's an important element of valuation that you should consider. So away from all the math and all the calculations involved in coupon and rates, default risk is obviously a big driver. Who assigns that default risk? Generally, it's been entities such as S&P and Moody's. These are third-party private companies that whose sole job as it is to put a determination as to what they think that the risk is of default. This is just an example of how Moody's and S&P grades things, AAA being the highest, AA, single A, all the way down to junk status or non-investment grade status. They assign these ratings by doing a lot of analysis. Sometimes they do a better job than other times. As we saw in 08 and 09, there was quite a few sectors where they didn't do a very good job, and what investors were told were AAA in effect weren't. There's a lot of reasons for it, but at the end of the day, it had a lot to do with kind of the lack of transparency and some changes that occurred in the marketplace that, frankly, Moody's and S&P hadn't kept up with. The bond ratings are an important driver because different types of entities may be restricted in what they can invest in. So if I'm an insurance company and you've paid me premiums for 30 years so that when you pass away, your children are taken care of, I have a very strong fiduciary responsibility to make sure that I have the money to pay for that, and therefore I probably should not be investing that money in risky internet startup companies. I should be investing that money in bonds that are very safe and expected to perform. Just get a question from Mary Ann. Yes, sovereigns are rated. The U.S. is generally of the highest rating. Again, countries like Libya or Russia perhaps sometimes have lower ratings. And the process is similar as to what would be performed on a corporation. If you look at a country like Russia, the analysts at S&P and Moody's simply look at their income, taxes, tax revenues, their expenditures. They look very closely at their budgets, entitlements, infrastructure spending. And they also assess things like political stability, leadership, and some other things that may not be considered as much in a corporate situation, but for sovereigns, things like that are certainly important. And frankly, right now, with some of the congestion that we're experiencing in Congress, it reflects badly on the U.S. You can have all the money in the world, but if you can't agree to write a check and make a payment, that can certainly cause a default. Next slide is default risk and bond ratings. We just talked about this. In a corporate environment, financial performance obviously are the drivers. S&P and Moody's have a whole army of analysts and accountants that go through financial statements, speak with management, and make a lot of the assessments that any investment analyst would typically do to get a feel for their liquidity, the cash flow position. But then there is, as we just talked about with the sovereigns, there's also kind of qualitative factors. So the ability to pay may be there, but there also needs to be a willingness to pay. And so secured versus unsecured, bonds can be issued with some sort of collateral backing them. A lot of times in municipal bonds, you'll see a city wants to build a tollway, so they'll borrow money to do that in the bond market, and the security is the tolls that are collected. So the bondholders can feel good that even if the city of Dallas goes bankrupt and can't pay back the bonds that they issued to pay for the tollway, they at least know that there's cars going through that tollway every day that are paying tolls that can go towards paying them back their investment. Guarantees can be made from various reasons. You know, just like sometimes students will get a cosigner on a loan or a lease. Borrowing entities, whether they're corporations or sovereigns or other entities, can get guarantees. It's simply someone else guaranteeing those payments in the event that the primary borrower defaults for whatever reason. We talked a little bit about call risk. Again, kind of a practical example is an issuer has an outstanding bond with a coupon rate of 10%. So a borrower's gone in the market, borrowed money for 10 years at 10%. But say a year later, market rates have fallen suddenly. And they could go out into the marketplace and basically issue new bonds to pay back the first bond, but now they can borrow at 8 and pay back the bonds that were paying 10. It's simply a refinance. Many of you may have encountered this in your mortgage or in a credit card. You know, sometimes you'll get a second offer to loan you money at a lower rate. You'll simply borrow that money from the new entity at the lower rate and pay back the old entity at the higher rate. Typically in bonds, callable features are stated. So an investor would have to know going into buying a bond that whether or not it was callable or not. Typically for corporate bonds and a lot of bonds, they're not callable. The issuer takes the risk that market rates could go down, and they do that because the investor likes certainty, and the investor wants to know that they're going to get their money and their rate of interest regardless of what happens to market rates. In the case where issuers decide to make the bond callable, that's certainly their prerogative, but the investors will price that in. So all things equal, if I offer you two bonds, one's both at 10%, both for 10 years. But one's callable, I will get less money for that callable bond than I will for the non-callable bond. And there's a lot of probability math involved in calculating that, but it can be done, and a reasonable valuation can be put on the difference for that callability. Reinvestment risk is simply what you suffer when you get called. Typically, as an investor, bonds get called when rates drop. And so you're left with getting your money back sooner and having a lower rate environment to reinvest in. So if I had invested in IBM at 10% and they called those bonds, they're generally going to call them because rates have fallen, which then leaves me kind of hanging out with my money back, but I'm no longer able to invest at the rate that I had. So that's the reinvestment risk, and that's obviously very closely related to call risk. Well, that's about it for the mechanics. Again, there's a whole lot more math involved in that stuff. Be glad to go over it with you if you like, but frankly, I did this for a living and I find it all very dry. So I thought that we spend the rest of the time just kind of talking a little bit about what I did and the experiences that I had working on Wall Street. Be glad to make this a discussion, so if you have any questions, please interrupt, and I'll just go through a few points here to talk about kind of what I did and what the markets are like, and then we'll finish the discussion by talking about what happened in 2008. Again, probably the most interesting part of my career. Probably will always be the most interesting part of my career. I can't anticipate anything else that would happen in my life professionally that would rival what I experienced in 2008. So bond trading. Bond trading occurs in money center cities around the world, but the largest hubs are New York, London, Tokyo, and Hong Kong. Why those cities? Simply because that's where there are large pools of capital and large infrastructures to support that. In this electronic world we live in, obviously execution and information transfer can occur anywhere, but at the end of the day, there's typically, for geographic reasons or for logistical purposes, the trading is very concentrated in one area. I worked on a trading floor. There was, I don't know, a couple hundred people in a large room, all sitting right next to each other, sometimes too close to each other, in my opinion. I had 8 to 10 computer screens in front of me relaying various kinds of information, numerical information, but also news information, economic information, sometimes a diversion. This time of year, I'd say half the monitors on Wall Street are probably tuned into a basketball game going on somewhere. But basically, the panels were there to provide information of various sorts, and then we're all sitting in front of phones and screens. Now, my phone had approximately 400 phone lines on it, and those phone lines were basically direct lines to various clients around the world. They would call in by simply lifting up the phone and pushing a button. They would ring me directly, and they would ask for a bid or offer on a position that I would then relay either electronically or by the phone. There is electronic trading in bond trading as well, just like you would see in stock trading. The difference is that some bonds are very homogeneous and generic, like a U.S. Treasury bond. So a U.S. Treasury bond that's a 10-year bond is a pretty generic bond. It's 10 years long. There's effectively no credit risk, and a 10-year bond is a 10-year bond is a 10-year bond. There's really no nuance to it. There's really no credit component to it. And so bonds like that, and they're heavily traded, all day and night. Hundreds of millions an hour are traded, bought and sold instantaneously. And for a product like that, electronic trading obviously works really well. You would simply see a screen that has a price that's flashing buy and sell with a small difference, which is where the bond trader makes his money. And that can go on 24 hours a day, 7 days a week. Again, most of the volume, though, occurs during business hours in New York, London, Tokyo, or Hong Kong. I used to joke, really the only time I got off really was from 5 o'clock on Friday until around 5 o'clock on Sunday, because as soon as 5 o'clock p.m. on Sunday rolled around, Asia would open. And so as soon as Asia opened, much to my wife's consternation, it meant I was kind of on, whether I liked it or not. So bond trading is around the world, around the clock for the most part. The U.S. has the most sought after bonds. Why would the U.S. be interested in foreign bonds? U.S. investors might be interested in foreign bonds because they have a higher yield. Because they are higher in risk, they yield much higher. And I guess the assessment that the investor has to make is it priced correctly? So if a U.S. 10-year bond earns 2%, but I can invest in a Libyan bond for 10 years that earns 20, I have to make that assessment. It's a pretty big differential in yield, so whether I think that's a fair price for the additional credit risk or not, that is the determination that investors have to make. And it's much like, why would I buy an internet stock that's making no money? Because I would anticipate at some point it will make money, and the money that it will make will be in excess of where the stock is trading now. So it's all about risk and reward. More risk, more reward. And as efficient as the markets are, they're not purely efficient. So I'm sure you studied the efficient market hypothesis. We often talk about markets kind of generically, but markets at the end of the day are a bunch of people that are making assessments and decisions, and you're not always right. And so the short answer is they might invest in foreign bonds because the yields are higher, and they think that the higher yields are worth the risk they would take of a default or of instability. So when you talk about traders, there's different kinds, mostly in two categories. A buy-side trader is someone who executes orders in the market, but they're working with or for a fund manager. So a fund manager would be someone that might make some sort of a macro call, might say, well, I want some exposure to Europe. I don't like Asia, so I want to sell Asian bonds and I want to buy European bonds. I like IBM over Microsoft, so I'd like to buy some IBM bonds and sell Microsoft bonds. They would form kind of a macro strategy, and then they would call down to their buy-side traders to make the execution. So execution is a skill in and of itself, and sometimes it's an art. Markets are constantly moving. There are better times to execute, worse times to execute. 6 a.m. in New York is not the best time to execute. There's not a lot of people around, and people are not quite awake yet. It's not the best time to kind of hope for the best execution. 10 or 11 o'clock a.m. in New York is a great time. Everyone's kind of awake, had their coffee, they're busy, they're executing, there's lots of transactions going on, and therefore liquidity is best. So buy-side traders are there to execute trades on behalf of fund managers, but they can also be on behalf of foreign governments. When the Central Bank of China would want to invest some of their flow of dollars into U.S. Treasury bonds, they would call into our desk, and a gentleman or a woman would be on the phone, and she would be a buy-side trader representing the Chinese government. So buy-side traders are there to execute, and they're kind of one type of trader. The second type of trader is what I did for a living. I was a sell-side trader. And a sell-side trader is basically a liquidity provider. They're there to stand in between buyers and sellers to facilitate transactions and to provide liquidity. We talked about electronic trading, and electronic trading works when there's lots of participants with lots of transactions, in a generic with a generic security. Where that doesn't work so well, electronic trading, is when you're talking about something that's not so generic. Maybe you're looking at 10-year maturity Microsoft bonds that are a year and a half old and have some sort of a subordination clause in them that adds some risk. So a sell-side trader then has to stand in between those buyers and sellers and allow the seller to sell when he or she wants to sell, and allow the buyer to buy when he or she wants to buy. And the next point is that oftentimes it's not at the same time. IBM bonds may trade 100 times in a day, but not at the same time and not in the same sizes. So if I have a client that would come in and said, I want to sell 50 million IBM bonds right now, ideally I would have a buyer of 50 million IBM bonds right now. Generally that was not the case. So as a sell-side trader, I would have to give a bid to that seller and buy it and kind of hold it and hedge it and hope that at some point a buyer would come in that I could then sell it to at a slight markup and earn my living that way. So it's about liquidity, and it's about standing in between buyers and sellers, because trades are not contemporaneous and they're not the same sizes. And there's always nuances between what is being bought and what's being sold, and that is what bid offer represents. So the price at which I'm willing to buy something and the price at which I'm willing to sell something is slightly different. You can think of that as profit margin. You can think of it as VIG. You can think of it as it's basically, that income stream is meant to represent the value added by being there for you as a buyer or a seller, being there so that you can sell when you want to sell and buy when you want to buy. I traded residential mortgage-backed securities, so I traded bonds that were backed by mortgages. So if you think about all the mortgages that are in the world, so all the people that you know, yourselves, family members that have mortgages, if you sum total all those mortgages out there, you could take all the biggest banks in the world and they still wouldn't have enough money to sell all those, to loan all that money. So the amount of money that's loaned by a bank to a borrower to buy a house with is much greater than the capital that the bank actually has. So the bank is actually just an intermediary. They initially give you their money to fund that loan. But at some point they package those loans up and then sell them into Wall Street. And they sell them into Wall Street to kind of generate more revenue for to replenish their capital that they can then go out and lend again. So their income is not generally derived from collecting interest payments on your mortgage. Their income is generated from fees and ancillary income related to that. And really who you're paying at the end of the day when you pay your mortgage is an investor somewhere. Could be an investment manager in Hong Kong. It could be the Chinese government. It's whoever holds that mortgage bond that is backed by your mortgage that's actually that's receiving that income stream. That vehicle is what provides liquidity, provides capital flow for the various parties that are invested that are involved in transactions. So bond traders, the best definition I've ever heard of what makes a good bond trader was by a gentleman named Bill Gross. Bill Gross he manages the largest bond fund in the world. He runs a company, an investment firm called PIMCO. His definition was the best. His definition was a bond trader is 1/3 mathematician, 1/3 economist, and 1/3 horse trader. And I thought that was humorous. I think what he was referring to is the fact that there's obviously quite a bit of math involved. But since we're talking about interest rates, and we're talking about the flow of interest rates, economics are obviously very important as well. So from an academic perspective, sure, mathematics and economics are important drivers of bond trading, are important skills to have. But the third element, which is rather difficult to kind of quantify, is the horse trader part. And at the end of the day, you have to make a decision as to what you think is worth doing. The question earlier was, why would I ever invest in foreign bonds when I can invest in U.S. bonds that are risk-free? Well, because, maybe 2% return over 10 years isn't good enough for you. It's actually about 2.7% right now. So if you were to buy a 10-year treasury bond right now, you would earn 2.7%. Not a lot of interest, especially for a 10-year term. And so maybe I would like to take a little bit more risk. And I think, let's say maybe not Libya, but let's just say maybe Japan, or that's not a good example. Let's say maybe Canada. So maybe I think Canada is a pretty stable country, but they're not the U.S., and so maybe they're yielding 3%. And maybe I'd be willing to buy Canadian bonds and take that additional risk to earn an extra 30 basis points in yield. A lot of those decisions are subjective. They are based on anecdotal evidence or an opinion. And that's the horse trader part about a bond trader. Unfortunately, the smartest guys never did that well in bond trading. It was my experience. The smartest guys were a little bit too smart. I've always said that it doesn't always pay to be the smartest guy in the room, because if everyone else in that room is being stupid, then you're actually the one that looks stupid. I used to have a friend in college who loved to gamble. We used to go to Vegas as often as we could. And you know, over time, the computer would disappear, the weight bench would disappear. Let's just say that he wasn't a great gambler. He used to love to say to me, you know what, if I keep doubling down, eventually I'll break even. And that was kind of his that was his gambling strategy. And I used to always kind of laugh at that. I guess there's some truth to that in theory. But at some point, when you're sitting at a casino at a blackjack table at 2 in the morning and you're out of money, you just can't double down anymore. And so again, you know, theory drives a lot of things, but it's not the only. There are elements to consider beyond theory that are important, and that's kind of what I think Bill Gross meant when he said 1/3 horse trader is an important aspect of being a bond trader. What makes a good bond trader? There's lots of information to process and analyze very quickly. My day as a trader usually started around 6:30 in the morning. I'd come into the office, sit down. 6:30 is nice because it's quiet in the U.S. Not a lot's going on yet. It's about lunchtime in London, so it's kind of in the middle of the trading day there, so I get a feel for how things are going in the middle of the day. And it's the end of the day in Asia, so it's 6 p.m. So in some ways, the markets overseas are kind of a looking glass or a crystal ball, so to speak. I get to see kind of how people are behaving in the middle of their day when I look to Europe, and I could look to Asia to see how people are behaving kind of at the end of the day. It was also about the only time during the day that I could actually kind of sit and think about things quietly at my own pace. News, information, I'd form a view every morning. Every morning I'd come in, I would form a short, long, and medium-term view. And a short-term view might be a couple of hours. A medium-term view could be a day or so, and a long-term view might be, you know, what I think might happen in a week or 2 weeks or a month. Once that quiet time passed, you know, right around 7:30 or 8 o'clock, things started to get really busy, starts getting really loud. The reason why trading occurs on trading floors is because trading hinges upon information flow. And so the reason why they cram so many people into such small spaces is that we can all kind of hear each other. It creates some unusual habits. To this day, I drive my wife crazy when we go to dinner, because as we're sitting there talking about what the kids did in school today, I'm also listening to the two church ladies behind me talk about what they did at church today, and I'm listening to a couple on the other side of the room have an argument about something or another, and I'm listening to the waiter complain about table 14. Over time, you just kind of learn to start kind of eavesdropping a little bit. It's not done intentionally, but you just train yourself to listen very carefully, and based on the tone of voice or a certain word, you might kind of refocus on that conversation. So trading floor is like that. You're surrounded by a bunch of people that are trading different things. What's going on with IBM 10-year maturity, you know, B-rated bonds might affect in some way what my RMBS is going to do. Or if I hear a big client come in and sell a bunch of something over there, it's a clue that he might be coming in to see me to buy something to replace that with. And so it's flow of information, it's noise, it's a lot of you're bombarded with economic, financial information all day. That's why there's TVs in there that are tuned to various stations, and things move very quickly. So it's really about hearing as much as you can, processing it very quickly, and making the right decision as to how much time you can spend thinking about it before you have to act. Sometimes you have a couple of minutes to think about something before you act. Sometimes you have a couple of hours. Sometimes you have a couple of seconds. And so it's kind of that fast-paced environment. I think some people love it, some people hate it. I really enjoyed it. It made for a day that was always very exciting, and every day was different. It's not always financial information that's relevant. The Japanese tsunami that occurred years ago was a big driver of what might happen to Tokyo markets. Just the most arcane type of information that might come over the wire sometimes can become the biggest driver of the markets that day. Bonds, as we talked about earlier, are rates. And as interest rates move, bond prices move. As bond prices move, interest rates move. If the U.S. Treasury rate moves a lot, then other bonds that are priced relative to Treasuries are going to move too. So if the determination is that GE is a very solid company, but they're not a sovereign, and so they have a little bit of risk, they might trade 1% higher than where U.S. Treasury bonds are. So if U.S. Treasury bonds are at 3% for 10 years, maybe GE bonds are trading at 4%. So to the extent that the baseline rates moves, the U.S. Treasury rates move, that drives rates in other markets. So that's an example where rates move bond prices, but the converse can be also true. Mortgage rates are a function largely of demand. So if a lot of investors are in the market wanting to invest in mortgages, that tends to drive mortgage rates down. So even though Treasury rates don't move, mortgage rates can move down in cases where investors want to buy mortgage bonds, and conversely, if they are large sellers in the market, sometimes that can drive rates up. You can think of bonds or rates, or you can think of rates as simply the cost of money. So when there's a lot of demand for money, the price goes up, and when there's a lack of demand for money, the prices go down. And inversely, as we talked about earlier, the rates move. Bond traders have to take risk. You never have all of the information. Again, it's a fine line that you have to walk in terms of waiting for as much information as you can collect. But if you wait too long, others move ahead of you, and you've missed an opportunity. So risk-taking is an all-day thing. It's again, some people love it, some people hate it. I enjoyed it. Again, as my wife would attest to, I like being right. And bond trading allowed me to demonstrate if I was right, or in some cases wrong, 100 times a day. Relative value is another element. Again, we talked about how buyers and sellers may not come into the market at the same place. So sometimes I'll have to buy something without a buyer waiting to lay it off to. And so I might have to make a decision as to whether or not I think that is something that's trading cheap or trading rich. And if it's trading cheap, maybe I'll be a little bit more aggressive in trying to buy that bond, so that at some point later I can sell it at what I think will be a higher value. So you're constantly making relative value decisions, and the thing about relative value is that can be difficult is sometimes everything looks really, really expensive. And so really what you have to do, because you can't not play, is to try to buy what looks least expensive. Sometimes things look really, really cheap, and you want to buy everything, but you can't, and so you have to make a determination and try to buy what is the most cheap. So, that type of analysis, that type of thinking, I think appeals to certain people, and it doesn't appeal to other people. But depending on your personality and what you find interesting, that bond trading might be, a good arena for you. So the last slide is what we'll talk about. I hope to get some questions out of this. It was really quite significant what happened in 2008. I'm not sure how much of you all have read about or experienced during that time, but it was quite a significant time in U.S. history, frankly. I think it was probably just as, if not more significant than what we incurred during the Great Depression. It's a very complex. It was a very complex thing that happened for lots of very complex reasons. But if I had to kind of simplify it for purposes of discussion, I would basically say, for the most part, it was a delevering event. And what do I mean by a delevering event? So leverage is basically debt. There are exceptions, but most of us in our daily lives utilize leverage. I've got a wife and 3 children and a mortgage and cars, and so I've got car loans and I've got mortgages. We borrow things, and what borrowing does is enables us to buy or own or hold more assets than we have money. Sometimes that's to put a roof over your head, sometimes it's to provide a car, sometimes it's to pay for student tuition. But there's nothing implicitly wrong with that. So if I can borrow money at a pretty cheap rate and buy a house with it that I expect to go up slowly over time, that's probably not a bad reason to borrow money. You can have a very responsible, sound person that makes a good income and goes out and borrows money to buy a house or a car or whatnot. And their income levels could be plenty to kind of maintain those payments and over time pay back those loans. And at the end of the day, they'll be in a better situation than they were had they not borrowed. The trouble in that situation occurs if suddenly those that lent you that money want all their money back immediately. And that's what I mean by delevering. And that's really what the financial system occurred in 2008 for various reasons. But there was a massive delevering. So I think you studied banking in one of your classes. I think you all understand that banks don't have in the vaults all the money that they lend out. People make deposits, they hold on to some of that, and then they loan out a multiple of that. And that's really how our financial system works. That's how money gets created. That's how the Federal Reserve controls and straits and kind of monitors kind of the amount of money that's in the system. That occurs at all levels globally. The problem that occurred in 2008 was suddenly a lot of lenders wanted their money back immediately. And whether it was a bank or an individual or a financial institution, in quite a few cases, those companies or banks or entities did not have the money to pay back immediately. And as a result, some banks failed. Merrill Lynch went down, Bear Stearns went down. So leverage in and of itself is not a bad thing, in my opinion. A rapid and violent delevering is what causes major problems. And that's what we incurred. And when I say we, I mean we globally, companies, individuals. We basically had too much debt outstanding, and because of some truths that came to light very quickly, people got scared and wanted their money back very quickly. And when that happened and people couldn't pay that money back, fear ensued, and there was a domino effect. I was working at JP Morgan in March of 2008. It was a Friday, and we were told that my boss came in and said, everyone needs to expect to work here all weekend. So no one's very excited to hear that, but it does occur in my business. We all assumed there was an acquisition that was going to happen. We assumed that we were going to be buying somebody, and we would be working very hard over the weekend to make sure that we did all the work that was necessary to get that done. So again, it was a little unusual, but not all that unusual. It didn't raise any alarms. We all kind of hunkered down and got ready to work. Friday night, my boss came in and said, we've rented 20 hotel rooms across the street, so don't go home. So that was a little unusual. We were all used to working late nights, but typically you could go home and get a couple hours of rest and come back in the morning and continue doing what you're doing. We were told not to leave the office, basically. By Saturday afternoon, suddenly we saw a lot of people walking around the floor that typically we didn't see walking around the floor. They were they looked official in some way or nature, and as it turns out, they were Federal Reserve officials, and that's when we started to realize that there was something going on. We started looking at we weren't told what we were looking at, but we were evaluating the prices on thousands and thousands of assets, and these assets were basically bonds. They were various types of bonds that were being held as collateral by an entity that we were then trying to evaluate. It got really strange when Saturday night they told us that everything had to be done by 5 p.m. on Sunday. Now that was very unusual because the amount of work that we were looking at was clearly it was weeks worth of work. So the process of going through a list of securities, a list of assets, analyzing them, trying to understand what the value of that asset was, is tedious. It takes time. You've got to be very careful. They're very large numbers you're working with. And so to have someone come in and say, well, you really need to do 3 weeks of work in 24 hours was very unusual. And that's really when we got a sense as to what was going on. And really what was going on was Bear Stearns was that entity, and they were failing. Bear Stearns was one company. Why did it matter so much? Bear Stearns became effectively a bank in that they provided counterparty functions to various counterparts around the world. So if I was the Bank of China and I wanted to transact, I might have money posted at Bear Stearns, and that would enable me to transact with Bear Stearns' other clients and vice versa. The problem was that the capital that Bear Stearns had, in some cases, wasn't what we thought it was worth. So a bond that was priced at par was really worth 98 or 50. And when that happens, suddenly you realize that all these outstanding loans that you have are really not collateralized anymore. Bear Stearns was a very large institution that had hundreds of billions of dollars of capital that was intertwined with the entire global financial system. And so the rush was, the reason why 5 p.m. on Sunday was significant was that's when Tokyo opened. That was when the world woke up. That was the first time that a financial transaction would occur. So that's when somebody somewhere would be expecting some money to come in. So money comes in and out of financial institutions, corporations every day, sometimes several times a day. There are repo markets which you may have studied. The financial institutions, the financial system is actually quite remarkable at how efficient it can be. Excess funds are lent out overnight. Fund shortfalls can be borrowed overnight. And at the end of the day, there's lots of transactions going on. It's very much like you wiring someone money or writing a check to someone. When they go to cash that check the next day, they expect to get that money. Just multiply that, times a million in various amounts across the world. And what would have occurred at 5 p.m. on Sunday night New York time was that Bear Stearns in Tokyo would have gotten a request for some funds, some money that was loaned overnight, or some money that was meant to fund a bond issuance, or some money that was meant to pay for something. And frankly, Bear Stearns would have said, I don't have it. And that would have caused an enormous ripple effect throughout the entire financial system that would have affected, everyday people. And to give you an example, it would be something tantamount to you going to the ATM on Monday morning to get out $100 or $20, and the ATM machine telling you no. And then further, the ATM machine telling you that, by the way, I actually don't even have your money anymore, and nor does the bank. And by the way, the bank's closed. And you've probably studied this in theory. It's called a run on banks. But what was peculiar was Bear Stearns was not a bank in the conventional sense. It was simply a very large financial intermediary. And so what would have happened had the powers that be not stepped in was that there would have been a massive run on the entire financial system. So monies would not have arrived where they should have. Individuals would have not had the money they thought they did, and it would have caused panic. It would have caused panic. It would have caused huge repercussions throughout the global financial system. We didn't really realize it until afterwards, the gravity of what could have occurred. But that was really kind of the beginnings of the 2008 financial crisis, because as soon as that happened, other financial institutions took a very close look at what their asset base was. And frankly, most of these assets that we're talking about were residential mortgage assets. They were loans or bonds backed by borrowers that had as collateral homes that were overvalued. And it sounds strange that at the end of the day that a home borrower is what almost caused the collapse of the entire global financial system. But you have to remember that the market was very, very large. Hundreds and hundreds, trillions of dollars of mortgages that are backed by trillions of dollars of homes that turned out not to be worth trillions of dollars. And so that I think we learned, we being the entire global financial system, learned that one, there was too much leverage in the system, and two, that we couldn't necessarily take things for face value. So there was a re-examination of S&P and Moody's, and did they know what they were looking at? And there's really not any one entity to blame. It was a combination of things. It was excess. It was miscalculations, opaqueness, some complexities that occurred. Getting a question. Same thing could happen with student loans. It could. The difference with student loans and mortgages is that there is no collateral with a student loan. So to the extent that you're a student, you're borrowing money for tuition, the lender knows you really have no collateral. And so the risk is priced appropriately. Whereas if I was loaning you money to buy a house with, the underlying assumption is the house is worth something that I can get back if you quit paying me back your mortgage. And the problem was that what I thought that house was worth was not in fact what it was worth. And so it's different in that mortgage loans, auto loans, other types of loans are collateralized. In the case of student loans, they're not. Now, what could happen is the student loan market was actually one that suffered quite a bit as a result of this crisis. Prior to 2008, private banks would loan money to students with a government guarantee. So Sallie Mae would encourage Wells Fargo to loan students money because they would guarantee those loans in the event of risk. Now that's changed a lot. I believe at this point the government is only a direct lender. Any private lenders that make student loans don't have a government guarantee on those loans. So that said, in theory, the market should appropriately price that risk. So if you want to borrow money from me and you've got a card to pledge as collateral, I'll give you X at X rate. But if you've got no collateral, which is the case with student loans, then I'll give you Y with Y rate. So the hope I would say is that with student loans, there are less things to be mispriced. Liquidity is also an important driver of what happened. Liquidity, I'm sure you studied the concept. What is something worth? And that was something that I spent a lot of time in 2008 trying to understand because I couldn't really come up with anything. It was an interesting discussion among 4 or 5 traders sitting around the desk saying, well, where can I put my money? Where can I put my money that's safe, that has intrinsic value? And frankly, you had 5 or 6 people that are very intelligent people that really couldn't come up with a good answer. Gold, not really intrinsic in value. Energy we came up with, but it's really hard to kind of lug around 55-gallon drums of oil. Food we decided was intrinsic in value, as was water. But again, not something that you can put a lot of your assets into and kind of carry with you or take with you. So at the end of the day, the value of assets is really, at the end of the day, is what people are worth, willing to pay for them at that time. And whenever you have an event like 2008, liquidity evaporates. And when there's no liquidity, strange things happen. I like to use the example of, a guy, let's say, walks into your classroom and says, I've got 4 Ferraris that I've got to sell. And they're $200,000 cars, and I'll sell them to you right now for $100,000. Well, if he walks into a classroom with 4 students, the odds are those 4 students don't have $100,000 in their pocket at the moment, and so he's not going to get that. And if that Ferrari salesman is in a tough bind or for whatever theoretical reason has to sell those Ferraris on that day, and his only buyers are the 4 students in that room, well, suddenly those Ferraris are probably worth $20 or whatever those students happen to have in their pocket. So liquidity is an important driver of value. In the case of what happened in 2008, liquidity evaporated. There was a lot of fear in the market. So suddenly, not only were certain assets truly not worth what they were on a fundamental basis, they were not even able to garner the value that they did have because of liquidity, because of a lack of liquidity. So when you have the compounding effects of deleveraging, fear, a rippling effect, and liquidity drain, that's what happens. And that was a really fearful time in the market. It's again, I don't think I'll ever experience that again. Some of the quantitative people like to talk about standard deviation events, and I'm sure you've all had some statistics, but I would consider what happened in 2008 a 4 or 5 standard deviation event. Don't anticipate it ever to occur again in my lifetime. At least I hope it doesn't. And I quite frankly don't believe it'll happen again for another generation or 2. Could it happen in smaller sectors on a smaller scale? Yes. Student loans, municipal bonds, but nothing to the level that it did at that time. That's all I have. Do you have any other questions? Okay, Professor Wheeler has a few questions.
What courses did you take to get into bond trading?
So I started at UT, and I was a finance major, and I thought that I was going to be an equity trader, because back then that's what was cool, stocks. Obviously math is important. I took a lot of finance classes, math classes. I was always good at math to start with, so I kind of moved towards that direction anyway. But equally important were economics, psychology, I found was interesting, history, you know, as a trader on Wall Street, you're surrounded by some of the most brilliant math minds in the world. So there's no shortage of smart math guys on Wall Street. But believe it or not, one of my greatest mentors ever was a professor of history. He was a history professor at University of Minnesota before he got into bond trading. I'm not quite sure how he ended up there, but really smart guy. And what he did for me was he really taught me to kind of think about the big picture. You know, I think that any kind of analytical work obviously has a very mechanical component to it. You've got to really understand what you have, and you really have to be able to dissect what you have. But it's also important to kind of understand and have perspectives that are not the same as everyone around you, and that will give you typically an edge in one way or the other, and at the very minimum will give you some perspective to let you kind of get beyond kind of the short-term thinking. So I took finance, economics, a lot of math, but I would say some of my coursework in psychology, in history were equally as important. Anything that really teaches you to analyze and to empathize and to understand different perspectives and different contexts, I think is valuable. Why did I change my mind from equity to bonds? So I was a senior. I was actually telling Professor Willie the story right when I came in. I thought bonds were quite boring and dry. In fact, it was probably one of the most uninteresting things to me imaginable. I dreaded the bond classes that I took and the chapters that I had to go over that were, you know, bonds and bond math. I found it very dry. My senior year in school, I took a course that was labeled Real Estate Finance. My father was in commercial real estate, and frankly, I was looking for a blow-off course. It was my senior year. I was pretty burnt out. I thought I'd take this class called Real Estate Finance, and I'd be learning about driveways and easements and zoning laws and things that I kind of knew about already, and I thought it would be kind of a really easy class to finish out my college career in. It turned out that it was actually a graduate-level mortgage derivatives class. And we didn't talk too much about derivatives today, but let's just say that derivatives are highly quantitative. It's a very highly quantitative subject matter. And basically, it was a very complex mathematics course as it related to mortgage bonds. Now, mortgage bonds are unique because they're extremely callable. And to understand that, you know, if you're a homeowner and you go out and get a mortgage, and you get a mortgage at 5%, and rates go down, you refinance your mortgage. So if rates go down to 4, you go get a new loan at 4 and pay off your 5, and you're all the more better for it. This is an option that you have as a borrower, and it's a tremendously valuable option actually. It sounds great, it makes sense to do. It's pretty straightforward. If I can get a lower rate, why not do it? The thing to consider though is on the other side of that is a bondholder, and he's basically all the benefit you're getting, he's suffering. So to say that you get a better deal on your mortgage because you pay a lower rate, he is now receiving a lower rate, and that goes back to the reinvestment risk that we talked about in the earlier slide. And so mortgage bonds are very callable, and they're very sensitive to rate moves, and they're very sensitive to rate moves in the wrong direction. So rates go up at the worst time, and they go down at the worst time for a mortgage bond holder. They're one of the more complex cash flows that are out there in the bond market. And so this real estate finance course was called real estate because it was talking about mortgage cash flows. And for all the math that we've already talked about, mortgage cash flows brings into it a lot of vector math, a lot of derivative math. We talked about duration, which is a change in price for a change in yields, but duration itself moves, and that's called convexity. So the rate at which prices move, the rate itself moves at a varying rate, and that rate itself can move at a faster or slower rate. And the movement of that change in rates can then drive a faster or slower move in that rate. So you're talking about the first and second derivative of duration. It gets very complex. I won't bore you with it, probably already have. But that's what that class was. So I thought I was going to be talking about utility easements and zoning laws, and I was actually talking about a level of mathematics that even I, who liked math, was beyond. But all that said, it was very interesting to me. It brought in a new element to bonds that I didn't really understand. At the same time, I was learning about the real estate market, how mortgages are funded. Some of the things that we talked about today, how, you know, I was always under the impression that a bank made a loan and that's how they made their money. They paid you 1% on your deposit and they made a mortgage at 4% and that's how they made their money. It seemed pretty boring and dry to me. But the reality was those mortgage cash flows were pooled and they were sliced and diced and cut up and structured, and it kind of added, I know it sounds strange, but kind of added a creative element to bonds that I wasn't aware of, and that's kind of what kind of hooked me, and that's how I started kind of going down that path. My first job was with Bank of America working for their mortgage company. I basically came out of school and looked for the largest mortgage company I could find at the time. It was Nations Bank, and that's kind of how I started down that path. Another question? Yes. I think the question is, what is my opinion of mortgage bonds? I think that the mortgage bond market is a very important market. Home ownership is, we've had our ups and downs clearly in the last couple of years, but home ownership is still a very important wealth builder for your average American. Buying a house provides two benefits. It puts a roof over your head, and it also gives you a vehicle to save money and build wealth. As I said before, if you took all the mortgages that were outstanding in the U.S., you could take the 20 biggest banks in the world, and they still wouldn't have enough money to make those loans. So the mortgage bond market enables borrowers really to borrow more money than banks have to lend. And so I think it's a very important market. It's had its issues. It's gone through some evolution here in the last 5 or 10 years. I think it'll continue to evolve. But I think that I think home ownership is an integral part of being an American, and I think it's for a lot of people, it's a vehicle to building wealth. It's a vehicle to security in the future, and I think that the bond markets are critical to providing that. So does it need some regulation? Probably. Does it need some oversight? Probably. But at the end of the day, I think it's a vital part of our economy. And I'm sure you guys are looking at current events in the market today. I mean, the Federal Reserve is very aware of the impact of mortgages and the housing industry on American wealth and American expenditure. There's not a lot of direct discussion about it, but it's clear that the Fed is trying to keep rates low to give as many Americans as much time as possible to bring down their borrowing costs and free up capital for other things, whether it's to live on or to invest. So again, none of that would be possible without the MBS market. I think it's a very important market, and even with all the bad press it's received over the last 5 or 6 years, I think it will continue to play a very important role in our financial system. Okay, well, thank you again for having me. It's been a while since I was able to talk to them, so I enjoyed it. I'll leave my email address with Professor Wheeler. If any of you guys have any questions that you want to follow up with, please feel free to send me an email. And thanks again.
All right, that's it. I'll wrap it up, and everybody's typing their thank yous, Roy. So thank you very much for coming, and we appreciate you being here. That's all for tonight. If you have anything, send me an email. Otherwise, I'll see you next Tuesday at 6:30. Thanks, everybody. Good night.